It's been a long wait, but it's odds on that we will get a rate cut from the European Central Bank when they meet on the 6th of June. There's also a reasonable chance that the Bank of England will join the party when they meet on the 20th of June. But the big question is whether the US Federal Reserve make a cut in June too. And that would require the inflation data there to behave, with the prospect of a significant slowdown in the US economy adding to the chances of a cut. Having enjoyed a faster fall in inflation when price pressures peaked, the disinflation process has recently stalled in the US. Core inflation is now lower in the Eurozone, and the gap with the UK is closing fast. As we've explained in previous market perspectives, we think that the US economy is slowing as the consumer retrenches, and that in turn should put the US inflation back on a downward path. The question is when this will show up in the inflation data, which have generally disappointed so far in 2024. Now, we think there's a reasonable chance that the data will allow the Fed to cut in June, but to be frank, the prospects are clearer here in the UK and crystal clear in the Eurozone area. One of the biggest barriers to US disinflation is rental growth, and that's been running at around 6%, and with the excessive weight on shelter in the US indices, the CPI, it accounts for 36% of that index. Well, there needs to be a significant slowdown there if we are to have any chance of hitting the 2% target. Now, one bit of good news is that the Federal Reserve actually target a different index, the Personal Consumers Expenditure Deflator, and that has a lower weight on shelter, but it's still 18%, which is double the weight of similar indices in the UK and Europe. So getting inflation down to target could be a more drawn-out process in the US. And in large part, this is because of their distinctly odd treatment of rent. It's not that rents are bigger there, it's just that they include owner-equivalent rent. And that's what owner-occupiers would pay if they rented their house from themselves. Don't ask me why they include it, but they do. Now, growth has been much stronger in the US than in the UK and Eurozone, but that too is surging. UK growth, it surged in Q1 and should stay strong for the rest of this year and beyond as consumer confidence improves and spending increases in line with rising real incomes. And there's a similar pattern evident in the Eurozone, though the pickup there is proceeding quite a bit more slowly. All in all, there are significant changes taking place in the world economy. Globally, economic recovery is underway. It's just no longer led by the United States. Inflation is coming under control, but the final mile to 2% seems to be harder work in the US than in Europe and the UK. Now, steady growth with falling inflation and lower interest rates, well, that's the Goldilocks scenario. If it comes to pass, as we think, that would be a positive background for financial markets. And we'll see what important upcoming data tell us. But until next week, goodbye from me.